Alex Patelis from macroeconomics research firm PatelisMacro is in our London studio. Thank you so much for joining us, Alex. There is so much concern that actually the recovery is much weaker than we were expecting, and therefore jobs will go, or there won't be a recovery in employment as fast as we were hoping. So how concerned are you about this?
Well, thank you very much for the invitation. It's a very interesting picture. We had a collapse in 2008 from the banking and housing problems in the United States. We had a very sharp recovery in 2009 with a massive monetary and fiscal stimulus that we saw. All the central banks pumped into the system. And now we're sort of in an in-between period where there's no shock to the system. Investors, of course, have gotten very excited by all those fireworks all those years, and we think they're just not prepared for a period of a little bit more calmness.
Alex, are you expecting a double-dip recession?
No, we're not. We just expect a period of below-trend low growth, but not a double dip for the simple reason that there's no shock to the system right now. It's actually quite a boring period from a macroeconomic standpoint.
If you speak to some of the unions across the world, they're saying, well, this is not the time to put austerity measures. This is the time to continue stimulating the economy. Do you believe this is the case?
Well, not really. The debt problem, particularly in some parts of the world, is real, both government debt and household debt. Society has to decide how to distribute the pain of that debt accumulation across its different members, and in that sense you are likely to see increasing tensions in parts of the world, but the underlying situation is one in which debt levels need to come down pretty much in most countries in the world.
But how do you deal with the fact that you can have a recovery and therefore you can have growth of a country, but still unemployment can be rising at the same time?
It's very interesting. Actually, the employment picture differs very much from country to country. At the one extreme, you probably have the United States, where unemployment rate has increased by 5 percentage points since 3 years ago. So there we do have very high unemployment rate, as high, nearly as high as the euro area. At the other end, we have countries like Brazil, where unemployment has actually fallen since the start of this crisis. So you have a very different picture. I would say, broadly speaking, the emerging market world this time around is in better shape, and parts of the developed world are likely to have employment problems for years to come.
How concerned are you about Europe in specifics? We are talking possibly about a return of the financial crisis if banks need to recapitalize more than they can actually afford to.
Personally, I think that the problems of the European banking sector are largely legacy problems and are largely behind us. They stemmed from the housing bubbles and busts in particular countries, Spain, Ireland, the United Kingdom, and of course countries in the core like Germany that were lending to these countries. Most of these problems are well known. The regulators are ahead of them. I think the real problem for the banking sector going forward is a demand-supply situation. On the demand side, you have in certain countries, again, United Kingdom, Ireland, United States outside Europe, where household debt is at very high levels, and there's going to be deleveraging going forward. So the demand for banking services is likely to be muted. On the supply side, similarly, you have regulators and society trying to control the banking sector in a sense, again, in an era of a lot of debt. You will find that society will try to regulate and tax the banking sector more, and that's sort of how we see it from the supply side.
Alex, thank you so much. Alex Patelis there.